Canadians across the country continue to feel the pressure of higher everyday costs, from groceries and housing to transportation and household essentials. As affordability concerns remain top of mind for many families, economists are closely watching what comes next for inflation, interest rates, and the broader economy. To help break down what's driving these financial pressures and what Canadians can expect in the months ahead, I'm now joined by Brendan Caldwell, Director of Caldwell Securities Limited. Brendan, thank you so much for the time today.
Well, great to be here. Let's do this thing. There's a lot going on, and a lot of conflicting forces, political and economic, all being brought to bear.
Well, as you said, let's do this thing. So, what is the biggest factor in increasing the cost of living right now?
Well, the very immediate driving force behind the cost of living is energy prices right this exact moment, and that's mostly as a result of the Strait of Hormuz being closed by this conflict between the United States and the government of Iran. Uh, it's about a fifth of the world's oil flows through the Strait of Hormuz, and much of it going to the Far East, and where we get an awful lot of our goods manufactured. So the price of energy in the place where much of uh, many of the products that we use day to day are get built, that price is going up as the global prices as well. But I think the bigger sort of seismic secular concern is our interest rates themselves. They were kept very low for a very long time in order, at least in part, that governments could continue to fund spending at a rate unprecedented in the history of the world. And they needed to keep interest rates low so that they could continue to borrow at a fairly low rate. Well, having kept interest rates so low for so long has made access to money, and interest rates are simply the price of money. It's supply and demand. So the low interest rates have kept the ability the availability, the demand for money quite high because the price has been so low. So inflation has been driven bigger picture by these low rates, and even now with rates having moved up considerably in the US and in Canada, indeed around the world, but particularly here, they're still quite a bit lower than what they were for the previous 50 years before they really fell off a cliff about 20 years ago. So, if you're talking generational secular moves in interest rates, they're still quite low even now, especially given the rate of inflation. So it's both interest rates and energy prices.
And Brendan, would you say that current inflation levels are temporary? And what impact is this playing on the rising cost of living here in Canada?
Well, in some senses, they are. The spike in inflation right now is largely driven by this whole U.S. Iran somewhat manufactured conflict in the Gulf of Hormuz, in the Strait of Hormuz, in the Persian Gulf. And so from right now, this minute, or at least this year point of view, the price of energy is pushing up the price of everything else. If, as and when that conflict gets settled, and hopefully it will, the price of energy will come back down again, as will inflation. But the trouble with inflation is it's irritatingly persistent. We put it to bed for basically a generation, really for this entire century. I mean, rates had been coming down since 1980, 81, and stayed low for almost the entirety of the 21st century. Partly that was an intentional policy on the behalf of central banks. Partly that was the world began with the century began with a crisis in 9/11 and has seems not be crisis free since. So there's a desire among central banks to keep rates low during turbulent times, but having kept it so low for so long, it's been hard to keep a lid on it. Now there's yet another crisis. So yes, this temporary oil price driven spike should pass, but having kept rates so long and money so available, once inflation gets built into people's expectations, once it becomes part of the norm, it's very hard, and indeed takes an entire generation to get it wrung out of the system. So the bigger, longer term inflationary trend, I think, is still very much there.
And do you think the younger generation is going to be the ones that feel this cost the most?
They are, in as much as the first thing that lifted off before the price of bread, before the price of uh, oil and gas, before the price of day to day commodities lifted off, the price of assets lifted off. And so the older people, the Gen Xers and the boomers, uh, they had assets and those prices lifted. Younger people, millennials, and even more Gen Z, haven't yet accumulated assets. So they've seen the price of assets lift, the very assets they need, like houses, but haven't had the ability to participate. So I really think the most important thing that someone that's younger now, they have something more important than money. They have time. And I strongly recommend that younger people do set aside a bit of money every month. It's $100, $50, $500, whatever you slightly can't afford,
Mhm.
in something that can grow in a mutual fund or some other asset. If you're going to buy a house, you may have to buy a quadruplex and figure a way to rent it out. But to accumulate assets, because I do think that inflation for both goods and services and for assets will be persistent. In order to participate, one needs to have some assets, which is going to be tougher. And my generation and the generations ahead of me caused it. It's going to be tougher for them to do.
Now, it seems like the Bank of Canada is in a lose lose situation. Raise rates, and households that are already being stretched thin start to fall apart. Don't raise them, and inflation runs rampant. What can they do here?
Well, I think you make a very good point, Theresa. I think they are in a lose lose situation because it really makes no sense to raise interest rates. Because normally, the idea behind raising interest rates as a central bank is to cool out the economy so that the demand for money settles down and people borrow less. Trouble is, there isn't a demand for money right now because the economy is not doing phenomenally well. The reason prices are going up is that energy prices are going up, which is having its own effect. I would suggest to the Bank of Canada they do nothing. Don't do anything. Whatever you do is probably going to make it worse. Cut or lower or raise. Give a message that you're going to be consistent. Leave rates where they are, because the actual fix is not now a monetary fix. It is a fiscal fix. The only thing that can be done up in Ottawa or in Washington, Canada and the US respectively, is to cut spending, and particularly in the case of Canada, cut taxes. More money has to be returned to the people that are earning it, particularly that are earning it from wages. The older generation is making money off of dividends, income, rental income, not earned income. So cut income taxes, but also cut government spending. Reduce the government demand of money that pushes rates higher and requires that rates be kept artificially low, thereby driving this asset inflation that we've seen. So I think you're right, Theresa. The Bank of Canada is in a very tough spot. They probably should do nothing, but the fiscal fix, the budgetary fix, should be to cut government spending and taxes along with it, so that there is lower secular inflation or secular demand for inflation in the years to come.
Brendan, thank you so much for the time.
Thank you, Theresa.